So joining us now is Arjun Murti. He is a partner at PE firm Veriten that invests in the energy sector. He's also a board member at ConocoPhillips and Liberty Energy, as well as a senior advisor to the energy group at Warburg Pincus. Arjun, it's great to have you back on the show. Let's start right there. Why is OPEC Plus doing this, especially at a time where there are all these question marks about economic activity globally and thus future demand for energy?
I mean, it's a great question. If we only had the trade war to deal with, I think oil would be trading up and down with the broader market, as you've been discussing. It really is a surprise announcement that after really 4.5 years since the depths of COVID, where OPEC Plus has tried to manage oil markets to keep inventories at or near the low end of the historical band, suddenly in March, and then it was worse in April and May, they've decided to bring a whole bunch of production back onto the market, and that's clearly what's driven this pretty big sell-off down to the 50s as we're seeing today. So
Saudi Arabia has been pretty vocal in saying that they can weather lower prices. And certainly they've demonstrated that over the years when they have decided to, open and close the spigot on oil production globally. But can U.S. producers, what's the number at which you start to see rigs come down and wells shut in and, perhaps some more pain in the U.S. energy patch?
I've been doing this for over 30 years, and versus prior downturns, the U.S. oil industry is probably as healthy as it's ever been in terms of the balance sheets are healthy. Unlike prior cycles, they didn't ramp up CapEx. We didn't, quote, drill, baby, drill this go-round. On the other hand, when prices are too far below 70, it starts becoming problematic. And when you're below 60, you're not going to get the kind of profitability investors expect. That it's still a little too early into the 50s. But if prices were to persist here for the next several months for this quarter, I think you're going to start seeing a pretty decent correction in activity levels versus if oil had stayed at 70 or higher.
Yeah, Arjun, I mean, you mentioned if this is supply driven up to this point, given that the macro data has held up so well, how much lower can oil prices go if demand really starts to noticeably slack off in the numbers?
The key thing to watch is when do inventories go from the low end of the range where we are right now to the high end of the range. Unlike other commodities like copper or gold, where you can buy a warehouse and pile things to the moon if you wanted to, oil has to be kept in storage tanks or terminals or on ships, or it has to be forced to be kept into the ground. That's really the sort of like dire scenario. You fill up inventories, OPEC's lost control, and you have to get to, quote, shut-in oil prices, which are well below $50 a barrel. We're far from that type of scenario right now. Exactly why OPEC has chosen the last 2 months in the midst of all this demand uncertainty to decide now they're going to abandon their prior effort to keep inventory lows is a reasonable question. But you're going to want to watch inventories. They're currently at the low end of the range. Do they get back to the high end of the range? And if they do, will OPEC step in again?
How quickly can they swing?
They can swing very quickly. It is small changes in supply demand. This is a business where 500,000 to 1 million barrels a day of less demand or more supply over the course of 3, 6, 9 months can swing you pretty quickly. So right now, things still look healthy. It's more concern than reality, but we are under no illusions that you can shift pretty quickly, which I would define as 3, 6, 9 months type periods.
The flip side of lower oil prices is, at least in theory, you start to get lower gas prices and other types of refined product prices. So what does that do? If that ends up being the case, what does that mean for economic activity more broadly and also for inflation?
Well, it's such a good question. And this is why this, let's just call it current down cycle we're in, doesn't seem like the other ones. You're right. Lower oil prices, your previous guest talked about it being better for inflation readings. It's good for demand to have lower prices. U.S. producers were already noting that for some of the companies, they were starting to run through their best inventory. And you've heard mention on earnings calls that companies are starting to look overseas and in other basins, which is a big change from the last decade where all anyone talked about was shale. So shale itself was showing some signs of maturity. And we're also in an environment, while the OPEC increase in production comes, I'll say it, at an inopportune time, we've always thought OPEC spare capacity itself is overstated. So yes, there's some oil to bring back on the market. Maybe it's 2 to 3 million barrels a day. That's a lot if we're having a recession. But that is probably the extent of it. So you could very quickly, by quickly I mean over the course of 1 to 2 years, find yourselves back into a much tighter market. So we are looking for those kind of signs going forward.